Happy Friday and welcome traders. I am Rachel Dashiell, Senior Manager of Trading Services and your host for today's Advanced Charting Techniques webcast. Now, this is a webcast that we do make the assumption that you're already familiar with the basic concepts of technical analysis, and we're going to take it a few steps further. I know a couple weeks ago I hosted this webcast. I'll host next week's as well. So we're kind of building on this series of Elliot Wave Theory. I put the last time's webcast from 2 weeks ago in the chat there, so you guys can keep an eye on that and watch that or review that coming into today's session. But today's session, we're going to focus on corrective waves and what that looks like. We'll look at some live examples. But as far as our chat today, I do have my friend and colleague Scott Thompson in the chat, so please feel free to chat in your questions, comments, requests during the session today. I'll be sure to keep an eye on those. And then if you find this video helpful, please smash that like button, give us a thumbs up, and please subscribe to us on Trader Talk Schwab Coaching. Now, before we dive in, let's hit those important disclosures here. So this information that we're going to cover is for general and educational purposes only. This should not be considered any type of recommendation or advice. And options carry a high level of risk and are not suitable for all investors. And today we will cover the paper money software application. Keep in mind that there are some major differences between paper and live. Now, as far as our agenda today, we're going to just start with a really quick market overview. As you can see, the markets have been pretty loud today. We're having a little bit of volatility, so there's definitely a few different things to look at. We'll then pivot our discussion into the meat of our webcast today, which is how to implement some of these technical patterns, the pros and cons of various technical indicators, and look at some examples on the charts. So again, we're focused on Elliott Wave Theory and looking at corrective waves. Last time we looked at impulse or motive waves. Now we're getting into corrective waves. So just to start us off, let's dive into our market overview here. We're looking at the S&P 500. Obviously, we are down a little bit today. Nasdaq's getting hit a little bit harder, but the S&P is down about 1.75% right now, and it is made its way through the 20-day moving average. And another level of support that we actually may be touching right now and may see some buying pressure at is, I will draw it for you, is some Fibonacci support. I thought we could pull these out since we're talking about Elliott Wave today. We had a wave higher, and then we're having a pretty deep corrective wave that we're seeing right now to the 61.8 retracement of that prior move, which was our impulse there. So keep in mind, this is where we may see a little bit of buying pressure right here around 74.40 or so. But if we cannot hold on to that, we may see a lower drive towards maybe this level right here around 73.30, which has been touched a little bit of times. That's where we had that consolidation before that prior move. So if we do have a deeper pullback and can't not hold 74.40, we may be looking more towards 73.30 in that case there. So I did want to pull up our whiteboard here to just do a quick hit review of Elliott Wave Theory and review some past notes from that last webcast where we talked about this. And Elliott Wave Theory is basically based on the concept that the market moves in waves. You know how waves in the ocean move? If you've ever been to the ocean, you have a move with the waves to the shore, and then you have a little bit of pullback and getting ready for that next move. So that's kind of what we're seeing in the market with different waves. And we've talked about how we have a full Elliott wave cycle of 5 waves, which are the motive wave or the impulse wave in the direction of the primary trend. And then we have 3 counter trend waves, which are our corrective waves that give us a complete cycle. So I'm going to draw this one more time so you guys can see it and make sure my annotations are up. Let's actually, before I do that, let me expand this so we can just have a big whiteboard here. So I'm going to pull up my annotations, and this is what that 8-wave cycle looks like. Wave 1, wave 2 corrective, wave 3, wave 4 corrective, wave 5, and then we have A, B, C. Okay, so this is 1, 2, 3, 4, 5. So that's our motive wave. So we talked about that in depth 2 weeks ago. So we have three waves in the primary trend direction. We have two smaller corrective waves, and then we have our three wave corrective wave here that is against that primary impulse. Okay, so what we're doing today is we are focusing on this part of the Elliott wave cycle, just on corrective waves. We talked about motive waves. Now we're focused on corrective waves. Next week, we will actually talk about how to trade these waves. So we're just setting the groundwork for you guys with Elliot Wave Theory. And then next week, we'll talk about how to trade these. So essentially, when we're looking at various waves like this, we have corrective waves can actually move in a few different ways. So the two main ways that corrective waves can actually develop is actually a very sharp movement to the downside. So that is a very sharp corrective wave. Or we have a sideways corrective wave, which again is just like a little bit of maybe some range bound price action, a little bit of distribution or accumulation before that next move higher. So essentially that's what we're seeing here. Now, remember that we do have some rules with these waves as well. So I want to revisit the rules that we have with our Elliott wave theory. And number one is that wave two never moves beyond the start of wave one. So remember, we usually have some pretty deep corrections in wave two. Usually it's a 61.8% retracement correction on wave two, but it never retraces past the start of wave one. Now, another rule that we had was that wave three can never be the shortest motive wave. So it doesn't have to be the longest, but it cannot be the shortest. And then the fourth rule, or the third rule, I should say, I'm getting my numbers twisted. The third rule is about this fourth corrective wave. It can never enter the territory of wave one, meaning that this wave cannot move down here and enter this territory of wave one or wave two unless it is a diagonal. So unless it is a diagonal. So we may look at one of those today as well, but again, we're going to stay focused on those corrective waves here. So I'm going to get rid of that screen there, and then I'm going to get rid of my annotations here to clear those. I'm still learning how to use this tool, so bear with me here. Okay, so let's first look at some of these corrective waves. I already mentioned that they're either sharp or sideways. And so we're going to start with the sharp waves first. And sharp waves are what we call zigzags. And so we're going to look at an example of a zigzag here. And let's take a look at, where was my zigzag example? We're going to look at in a video. Okay. So we're going to take a look at NVIDIA here. I'm going to remove the study. We're just going to focus on price here. Okay. So we obviously had a big motive wave. So we had a primary trend move up in this, I would say, shorter time frame. And now we're looking at kind of a little bit of a sharp correction. So essentially what zigzags are in this scenario is they're a 5-3-5 pattern. So remember when we talked about how each of these waves actually has various waves in a lower degree? What this essentially means is that we have a 5-wave motive wave down into this wave A. So wave A is essentially a motive wave of a degree. So that is a 5-wave pattern. So I'm going to draw this again with the 5-wave. So this will look a little bit like this. So we would have 1, 2, 3, 4, 5 down into wave A. Now, wave 2, that wave B, is going to be a 3. So it's going to be a 1, 2, 3. And then the last wave is going to be a 5 again. So 1, 2, 3, 4, 5. So essentially zigzags are a 5, 3, 5 method. And we know that they're a 5-3-5 method because we know that the waves that have 5 waves, those are those motive or impulse waves. Those are our sharp waves. So those move in the direction of whatever that trend is at that time. So just remember, every time you see those formations that have a 5 wave in them, you can just assume that it will be sharper type of move. So that is a 5-3-5 that we're looking at here. Now, to actually see the 5-3-5, you're going to have to piece down into a lower time frame. So we're going to look at that as well to take a look at the lower time frame. So I'm going to go back to, let's get those annotations off, clear all drawings. Okay, perfect. So if we go down a time frame and we look here, maybe at the, let's see, at the 180-day 4 hour. Okay, so we're looking at a smaller time frame here. And we can actually take a closer look at what price is actually doing. So we can actually take a look at the 5-3-5. So we have 1, we have 2, we have our 3, we have our 4, and we have our 5. Okay. So this is our wave 1. Here, I'm going to label these for you. So this is wave 1, wave 2, wave 3, wave 4, and here's your 5. Okay, so this is our 5, and then we'll have the 3 and then the 5. So we'll label it again. But you guys are probably wondering, well, Rachel, you just glossed past that one rule, that wave 4 can never enter into the territory of wave 1. And the answer I will provide for you as this. Typically, you see this occur when you have like a leading diagonal. So what we're having here is a leading diagonal. And remember, I said diagonals are the only ones that you can have price actually enter into the territory of wave 1. And that basically means that you're having almost like a wedge type pattern in this first beginning portion of that 5-wave move. And usually your wave 5 ends up being extended. So that's what a leading diagonal is. If we had a ending diagonal, you would see that wedge kind of near here. And you would see a extended wave or wave extension of wave 1. So that's kind of like our 5-3-5 there. And then we talk about, or I guess our 5 there. Now we talked about the 3. So zigzags are the 5-3-5. There is our 3. So we have 1, 2. This is our corrective wave, wave 3. Okay, now let's get ready to do the last one because the last one is a 5. So we're going to go down wave 1. This is wave 2. This is wave 3. This is wave 4. This is wave 5. Okay. So this could be telling us if this, again, this is really subjective. So you're going to use different tools like we talked about the other time about using the Elliot Oscillator, using some of those rules to identify what could be an Elliott wave pattern. But this is one that my eyes are seeing that this could be a possible zigzag. We had a very sharp correction from those highs, lost about $40 in value. I would call that a pretty sharp correction. And so this is our 5-3-5, and this should be the end of our corrective wave here, if this is truly a 5-3-5, or if this is truly a zigzag. Now, there are cases where you could actually have a double zigzag. So in those cases, we call it a double zigzag or a double 3, where your labeling actually has to go a little bit differently here as far as where you kind of place your labels. But essentially, what that double zigzag is, you would label this still as ABC, but this move right here becomes labeled as a W. Oops, a larger W, because that's the larger wave. And then I'm going to draw what this could be if the corrective wave is still occurring. So this could be another 3 that connects the zigzag. So you're going to have a 5-3-5. Then you're going to have this 3 wave in the middle. And then you're going to have another 5-3-5. So we would have another 1, 2, 3, 4, 5. And then I need to give myself a little bit of space here. Let's go here. 1 second. Need to give myself a little bit of space on the chart. Whoops. You guys bear with me. I am still learning how to use this tool. Okay, so I'm going to try this one more time. So we have our 535. I'm going to draw that here. 535. And that is a zigzag. Okay, so what we're going through right now is a zigzag. This is our sharpest corrective wave. Now, what I'm showing you here is if this wave is not done and this still needs time to correct itself, sometimes this zigzag forms a double zigzag. So again, a double three, or we call it like a combination or a double zigzag, however you want to call it. And essentially what it is it's two of these 535 patterns looking just like this, but you have that wave three in the middle. So this would be labeled W of the wave. This would be labeled X, and then we have another 535 that could take us lower. So 1, 2, 3, 4, 5. This would be your Y. We have 1, 2, 3. And then we have, all right, I guess I actually did that wrong. This would be your A, this would be your B, and 1, 2, 3, 4, 5. This would be your C, and ultimately that would be the end of that corrective period, which would be your Y. So if this does prolong itself, this is what this type of corrective wave could look like with this double three combination. I'm going to keep an eye on the chat to see if we do have any questions. Okay. I have one. Okay, so one comment from Art. He said, Rachel, we need a tool that can identify these waves automatically. Otherwise, we are just guessing. So last week or the week before, we actually talked about an indicator that could help you identify some of these waves, which was that Elliot oscillator. So if you guys remember these rules with the Elliott oscillator that we talked about, this helps you identify the waves that you are currently in. So if you guys remember those rules with that Elliott oscillator, essentially this is basically calculating the difference between two moving averages, a 5-period moving average, a 35-period moving average. And we talked about how the highest and lowest values of the oscillator could essentially may indicate a bullish or bearish wave three. So we've kind of talked about that, about kind of what wave three looks like. We talked about how when we see that cross of a zero line, that could be a possible wave four to the downside. And then we talked about how if this oscillator is reaching all-time highs, but price isn't necessarily reaching all-time highs, that could be wave five. And so what this tells me is that we're probably not in wave five yet, because if you notice here, we had the highest wave of this oscillator right here, and that also reached a high in price there. But let's look at the larger wave. We could say that this is wave one, this is wave two, this is wave three. Maybe this is a big corrective wave of wave four. It is entering the territory of wave one, but this could be a leading diagonal, which would mean that wave five could be pretty extended in this name. So again, those are kind of some of the ways that you can use this to identify some of these waves, but they will be pretty subjective as well. So it's an art, not a science, just like anything with technical analysis as well. Let's see if we have any other questions. Okay. Julia asked, so once you're in the corrective waves, you can violate the territory of the motive waves up, but does it ever violate the start of wave one? No, it does not. So that would be the change of a primary trend. You'd have to essentially change your labeling, because if it violates the start of wave one, you've probably started like a new motive wave. So that's kind of what you've got there. So those are what flats or zigzags look like. Next, we're going to go to flats. So remember, zigzags, we said, were the very sharp pattern, and that's because they have those 5 waves in them. So zigzags are a 5-3-5. They have the sharp motive waves within that corrective wave. And then Now we're going to get into the two different types of more sideways, kind of like churning type of correction. So I would say the zigzags are what we call the correction through price, and the flats and the triangles are more of a correction through time. So let's take a look at a couple different flats here. And I'm using some live examples because I think the most important thing when you are identifying some of these types of waves, the most important thing to do is identify these in real time when you're trading. And you want to know when these are complete because that will tell you when and where to take that specific trade and where to place your stop to the downside for your risk management. So again, we're going to cover that in next week's session, but I want to get through the rest of these corrective waves here. So we're going to use a flat as an example, and I'm going to use, I think this is Altria group here. Okay, so what we're using in Altria group is essentially looking at another corrective wave. And so a flat is essentially just kind of like this sideways price action. So you can see we had a move up, we had a new high being made, then we had a move down, which is our A. We had a move up back to resistance, which is our B. We had a move back down to support, which is our C. So this is what we would call just a standard flat. And then we have our move to the upside. So essentially what this flat is telling us is that we are looking for a break above B to essentially take a long position because this is essentially a possible corrective wave within a longer ongoing uptrend is what this is telling us. Now there's a couple different variations of flats as well. So flats are essentially, so I'm going to write on this again with my annotation tool. So flats are essentially a 3, 3, 5. So you have a 3 wave down, you have a 3 wave up, and you have a 5 wave down this way, and then you have the move to the upside, okay? So we can actually see what this looks like when we piece down into the lower time frame chart when we can take a closer look at this. So I would suggest you to really zoom your chart into maybe using a 4 hour hourly chart over the life of this flat. But I do want to talk about some different types of flats that you may see because they may look pretty close to this, but there's definitely some variations of these as well. So with flats, you have just a regular flat. So this is a regular flat. And then you also have expanded flats and running flats. So in an expanded flat, you have price kind of going up in an uptrend, and then you have the consolidation from A, B, C. So this would be your A, this would be your B, and this would be your C. And so when you see this, okay, I'm going to write this. This is expanded. Okay. When you see this, a classic signal of this is when it looks very much like possibly a top pattern. And this usually ends up being a double top that has failed because, of course, price is going to move its way back up to the upside. But essentially, when you see this, this is an expanded flat where C goes a little bit lower than A. And so you'll typically see this, you'll typically know that this is an expanded flat when you see a momentum divergence, like specifically in the RSI. So if you see that price is consolidating here, but you see this lower point, this point C, this latest corrective wave break a lower low than your previous support, which was that other corrective wave of wave A. Look for those momentum divergences because that will tell you that this is an expanded flat where you have that last little low, that last little liquidity sweep that's been taken out, and price, of course, with confirmation, would move to that upside to continue that trend. So that is an expanded flat. Now, the last one that we're going to talk about again with a uptrend, because we're talking about all of these in a bullish market. So a bull market, these are what these trends look like. If you were to take any of these corrective waves in a bear market, obviously you just flip everything. It's going to be the exact opposite. So you would have counter trend rallies, moving up again against the primary trend. So this is going to be our running flat. So you have price moving up, then you have that corrective wave down, that wave A, you have that move up, that maybe that little rally back up, and then you have B, and then the last one is C. So C is actually higher than A. So you're actually putting in a higher low. So this is where you're seeing the first early stages of that change of trend, because we know an uptrend is higher highs, higher lows. We know a downtrend is lower lows, lower highs. And so if we're making the same amount of highs, but we're making a higher low, we know that that uptrend is still intact. And that's where we can look for that possible move to the upside. So that is what we're going to be calling a running flat. Running flat. Okay. So again, this is more of a sideways type of correction, not a sharp one, a sideways move. We have a 3, 3, 5, and it's all going to be dependent. The name of it is all going to be dependent on that last wave 5, which is that wave C. So is it going to be an expanded wave 5? Is it going to be a shorter wave 5? Or is it going to be that regular flat where it almost looks like a little double bottom pattern that we're putting in there? So, for those of you that do trade technical patterns, you're kind of noticing some similarities here. You just need to understand where this pattern is occurring within the overall trend, and then you can mark out some of these different levels too. So that's why Elliott Wave Theory is just so invaluable with understanding markets, understanding waves, understanding trend, because once you grasp this, you are going to be unstoppable as a trader, to understand where to place profit targets, where to place stop losses to the downside if you do use that for risk management, because it gives you a very clear framework with systematic rules, and they are all of these we've talked about in the last class use Fibonacci multiples as well. So keep that in mind. And I have a couple questions in here. Let's see. Okay. Okay, if wave C goes beyond wave B, does that start the next Elliott wave 1? Yes, that would start the new wave, because the corrective wave C is done at this corrective wave. So if you have a bounce from there, if it goes beyond that wave B, yes, that is the end of your corrective wave there. And then let's see. Okay, if we have any other ones. So a running flat looks like an ascending triangle. Maybe a little bit, but we're going to get into triangles, and you'll actually see the different types of triangles there, and that's where you'll see a true triangle. This one, I would say it's a very soft way of describing like a triangle, but these are more of like horizontal type consolidations, I would say. So you're barely going to see that C wave. You're not going to see a huge difference between the edge of wave 1. So probably not enough to call it a triangle, because we'll get into what the triangles look like. So I'm going to clear all drawings. We're going to look at a couple different examples of triangles as well. So triangles are what we call a 3, 3, 3, 3, 3 pattern. And we're going to look at 3 versions of triangles, because we have contracting triangles, we have barrier triangles, and then we have expanding triangles. So this kind of dips into our trading price patterns class, but obviously with a flavor of Elliott Wave Theory. So I guess it's vice versa in this case. So let's look at an example of each of those types of triangles, and I'll talk through this with you guys. So with triangles, so we're gonna take the annotation tool out again. So triangles are a 3, 3, 3, 3, Three. Wow, I'm tired of saying three. But again, this is another sideways type of trend. And the idea is that the trend, especially in a bull market, would continue to the upside because, again, this is a corrective wave. And so what you're seeing here is you're seeing that upwards trend leading into this corrective wave. And then you're seeing this is wave A. So one, two, three, 1, 2, 3. 1, 2, 3, 1, 2, 3. And then our last wave should actually be down here, wave E. So that would be wave E. So that would be the end of that corrective wave. You'd look for a bounce off of that triangle for that confirmation that that was essentially that wave E. And of course, you want to look for a move beyond that resistance level there. But again, we're going to talk more about trading these formations, specifically the Elliott wave. And so with these types of contracting or I guess barrier triangles, I should say, barrier triangles are going to be ascending triangles in a bull market, descending triangles in a bear market. So you just kind of flip it on its head. So essentially with a barrier, you kind of think of like this as your wall, this as your barrier. So that's why they're called barrier triangles. And then you have those higher lows being met with those same level of highs at that wall or at that barrier. Okay, so that is what our barrier triangles are. And again, if you want to see that 3, 3, 3, 3, 3 corrective waves, you may want to actually go into a lower time frame. You can see those as well, but again, you kind of saw those here too within this larger time frame. Because as you piece down to the lower one, you're going to see even more waves. And then if you piece down to the lower time frame, you're going to see even more waves. So once you get started with identifying these, you can't unsee it in that way. So I'm going to clear that. So that is a barrier, a triangle there. So ascending, descending triangles, they're called barrier triangles. Now we're going to talk about a contracting triangle. Okay, so this is the best one that I could actually find here. And essentially with a barrier triangle, you are essentially going to have more movements here with this one too. So you're going to have, I guess I should mention this. So with, I know we talked about the flats and the zigzags being like this three-wave pattern. So you always label those as A, B, C. But with triangles, since they have the 5 threes, you're going to label them A, B, C, D, and E. Okay, so that's what it's going to look like here. So in this one, I will label this one as A, B, C, D up here. And this would have been our E right here. So when it broke through, that would have been our E. So, and it should have bounced to the upside with this type of a retracement here. Now it may be forming another type of corrective wave. We will have to see. But essentially, if we kind of zoom out and look at this from a trend perspective, I'll show you guys what to look at. We talked about that motive wave really leading us into that corrective wave. And we talked about how that corrective wave typically on a wave 2 makes deeper retracements than the corrective wave on a wave 4. This one's a pretty deep retracement that this made past the 50% retracement, almost all the way to the 61.8% retracement here. So that is definitely something to note. Again, just wanted to show an example of what these look like, but with the contracting triangles, these are essentially what we call like symmetrical triangles. So you're going to have the lower highs on the upside with a downsloping trend line. You're going to have higher lows on the downside with an upsloping trend line as well. So that is what the contracting ones look like. Now I'm going to show you an example. This one is a little bit from the past, or I guess it's still probably developing. I thought this was one that I picked from the past a little bit, but this is one that is still developing, and this is what we call an expanding triangle. So you may have called these broadening formations, broadening patterns. but we call these in Elliott Wave Theory expanding triangles. And so essentially you have the upper line rising, the lower line declining, and these formations are very, very difficult to trade. Very difficult to trade. And the reason why is because they are known for false breakouts. They are known for these. So you can actually see in this wave D, you actually had this false breakout to the upside here. And this is very, very common. So any broadening formations, or in this class, we're going to call them expanding triangles, you are typically going to see that move beyond that upper resistance or that lower support. You'll typically see price enter back into that. So that's why it's important to understand that this is a 5 wave corrective wave. That's your 3 3 3 3 3. Okay, so you have your wave A, which is small, you have your wave B, which is bigger, you have your wave C, D, and then all the way down to E. So that E actually comes right into, I'll kind of show you this. If we look at our retracement, that wave E is going to come all the way down, possibly to this 61.8% retracement, or at least to that gap from what we're looking at, just looking at the slope of that line. So that's why as a trader, we want to be patient. We want to understand Elliott wave theory, because if we took a trade right when it broke out of that area, we would have been not so happy when price entered back into that triangle. So keep in mind that that is where price could go back into this zone of support, which would break that horizontal support as well. But again, we're just using this as a guideline. It is an art, not a science. So keep in mind that these are the differences here. So any questions in the chat? Because I know we've covered a lot so far today, so I want to give you guys some time. Oh, and I also want to show you something cool about these triangles too. So typically when you measure these, this wave A will typically be 0.618% of that next larger wave. So if you actually measure these, you may actually see something here. I'm trying to find a way to measure it here. We'll do this. Let's see if this makes it. Okay. So you guys can actually see if we measure from for wave C, and if we take this horizontal distance here and we look at that 61.8% retracement, and we take that little line. I'm going to move that line over here. Typically, it's the exact distance of that. So that's kind of the funny thing with these. So typically, wave C is, or I guess typically wave A is 0.618% of wave C. And then you're going to see that same type of reaction with wave E as well. So that's why they're kind of expanding that way. So hopefully that was a little bit of fun there for that one. So any other questions here? Let's see. Yeah, Scott, you're doing a great job helping me out in the chat. I'm looking to see if I have any other ones here. So you guys, let's just do kind of like a quick review of everything that we have discussed so far. So we're going to go to the tools, we're going to go to our think log, and we're going to place some notes here on Elliott wave theory. Okay, ignore all of these other moves that I have in here for from past webcasts. Okay, we're going to add one for Elliott wave theory. Here we go. And so we're going to take all the rules that we talked about today and how to identify these. So this is just kind of like your quick sheet, I can't talk today. Cheat sheet. Your quick cheat sheet of understanding a corrective waves here. So we're gonna hit save. These are gonna show up here. So remember, zigzags are sharp corrective waves. They are a 5 3 5. They are labeled ABC. Our flats are more sideways action. We talked about regular flats, expanded flats, so running flats, and those are our 3, 3, 5. And then we also have triangles. We talked about barrier triangles. We talked about contracting triangles, and we talked about expanding triangles. And those are sideways corrective moves that will likely continue the ongoing trend depending on what type of wave, a corrective wave you are in, whether it's 2 or whether it's 4. And then those are labeled A, B, C, D, E. So thank you so much, Scott, for just kind of helping us out so much in the chat, answering all those questions. You guys have been great as well. Again, I put that link from the last session 2 weeks ago on Elliot Wave. If you did want to review any of the things that we talked about in that class, that's kind of at the beginning of the chat, so you will have to scroll up there. But I want to thank you all. If you found this useful, please smash that like button and give me a thumbs up. Please follow both Scott and I on X. He is Scott Thompson CS. I am Rachel CS. And then please subscribe to us on Trader Talk Schwab Coaching. And join me next week at the same time on this class for talking about how to trade these Elliott wave, corrective waves and impulse waves. So see you later and have a great rest of your weekend.